Hi, I'm Dan Looker, business editor with Successful Farming Magazine, and with me today is Steve Johnson, farm management specialist with Iowa State University. We recently talked about some really important changes that are being offered for crop insurance this year, including the ability to change your average yield, your APH, and maybe you've already made those decisions, but today we're going to be talking about what do you do next once you've decided how many bushels you're going to insure. Steve, what are some of the options in terms of marketing and planning for marketing that people should be considering this year?
Well, Dan, I'd like to add on to the idea of crop insurance is this ability of selling your crop insurance bushels. Let's take a look at some strategies that might work. Number one, revenue protection is the preferred strategy. Again, revenue protection is the sale of crop insurance bushels. These are what I call delivery bushels. I can deliver those to the co-op, the ethanol plant, the river terminal, the feedlot, because I'm guaranteed bushels, my APH times my level of coverage, but I'm also guaranteed price. And that price is the higher of the projected price, the December corn futures, November soybean futures, average price in the month of February. That's called projected price. But if the harvest price, those same two futures contracts in the month of October are higher, I get the higher of the two. So this idea of delivery bushels typically is overcome with revenue protection. Your guaranteed bushels, APH times level of coverage, and your guaranteed price, the higher of the projected or harvest price. Number two, you're going to know about March 1st what that projected price is. I call that the barometer because you will know how many delivery bushels you will have, and when December corn or November soybean futures are above the projected price, you should have a comfort level in selling bushels, guaranteed price. If you're short of bushels, you will receive an indemnity check shortly after harvest. And if you have higher prices at harvest than the projected price, it'll be reflected in that indemnity check. And then number three, I encourage producers this year, especially in 2012, think about generating adequate cash flow needs. Again, this strategy probably is more so for the producer that has borrowed funds, whether that be from machinery, equipment, or land, or operating notes, but generate from the sale of your 12 bushels in the spring and preferably early summer months, adequate cash flow so that if there is a larger crop on more acres or some sort of a financial uncertainty in the U.S. or globally, at least you've got enough bushels sold that you've got some time. And the advantage is that then the bushels that you're holding into spring and summer of 13 are primarily stored on your farm with a lower cost of ownership. And then lastly, I encourage producers that they can use futures and options, put option strategies, but I would target those for what I call the non-delivery of bushels, the deductible bushels, the bushels that are not covered by your APH times your level of coverage. And again, waiting to buy those put options into the late spring or summer months, a lower premium because of less time value.
That sounds good. I think this year especially, these strategies may be even more important. I just got back from the Outlook conference in Washington, and if you're talking about the current calendar year, the tax year we're in, things still look pretty good. But if we have normal weather, the USDA is projecting corn prices averaging about $5 a bushel. And we were talking about this earlier, $5 a bushel may not be what people are getting at harvest, right? That's another thing to consider, that this $5 price includes a lot things, right?
Sure, that's the national average price. So when you hear $5 corn, $11.50 beans that came out of the Ag Outlook conference, that's the national average cash price for every bushel that's sold and delivered between September 1st of 2012 and August 31st of 2013. So a producer that can perhaps sell in advance some 550, 580, 620 cash corn price. That'll be included in that average price. So harvest could be much lower than that. And again, I really think the opportunity is there for beans now is because we're already have November soybean futures, January soybean futures above the projected price. So if you're selling your insurance bushels, I think maybe you start with beans, and hopefully we get some sort of a weather delay, too wet somewhere, too dry somewhere for corn. But Dan, we also have the advantage of seasonal price trends. Let's take a look at what the seasonal price trends are for both corn as well as soybeans. For corn, the chart that you have in front of you is a line graph. It's a weekly futures closes every week for December corn for 22 years. So we go all the way back to 1990 through 2011. And what we can see is that corn prices on the futures tend to move higher from roughly mid-February and stay relatively high through mid-June. And so the other strategy is selling your insurance bushels, but using the seasonal trend. Again, I put a degree of caution for waiting till June. June is distorted on this chart as well as the soybean chart because of those extremely high prices that we witnessed in 2008 as well as 2011. But the idea of selling ahead before we have the crop harvested with the comfort level of insurance bushels revenue protection, which guarantees bushels, APH times level of coverage, and guarantees price. And then when we put these 22 years together and we compare December corn futures on May 1st to October 1st, the odds are about 77% that the price is going to be higher in that spring than it will be in the fall. So taking advantage of the seasonals. And again, let's take a look at the November soybean futures. And again, those same 22 years, a line graph. And it's pretty obvious is that the market tends to rally. Kind of in this case, maybe a mid-February, sometimes even longer than corn, perhaps a mid-July. Again, extreme price there in June and July, so a degree of caution about waiting. But selling perhaps when the price is above the projected price, selling weekly, what I call incrementally, selling your insurance bushels. And again, because this is 22 years, a caution on using 22 years of data. South America has changed this graph. The spring is still the high, but we oftentimes get a January and February rally like we've seen the last few weeks because of South America production and South America uncertainty. We've got a March 9th USDA crop production report, also World Agriculture Supply and Demand estimate that I think will likely reflect that. So perhaps taking advantage of the seasonality that comes with soybeans, but using crop insurance bushels and selling those insurance bushels is a part of my strategy, I think becomes important in 2012.
Sounds good, Steve. Well, thanks. That sounds like good advice, and I hope people will consider it. So thanks a lot.
Thank you.